The more you do something, the better you get at it. The better you get at something, the more you want to do it. The next step is, I'm still having trouble deciding, okay, I'm usually 25, 35%, 20%, 10% of the trades I put on, they're winners. So I'm usually able to ride those winners, and maybe I can get to some number that's reasonable. This is completely opposite. This is saying, hey, you know what? You've got to make 60, 70, 80% of your trades need to be winners. And it's your ability to manage those winners it's ability to manage those winners to create a net result that's higher than zero. And again, I mentioned this term, probability of a touch. I'm just going to show you what that means. So we have Amazon up here still. The statistical chance of Amazon, it's currently trading, can you go to just 4 strikes for a second? Amazon is currently trading for $254. It has an implied volatility in November of 38%, probably because it has earnings before November expiration. That's why it has a little jump in volatility there. If we look at Amazon right now, I'm sorry, 2 more strikes, right? 6? If we look at Amazon right now, the statistical chance of Amazon trading 265 by November is, or closing above 265 by November, is 34%. Now, as an individual investor, it's very difficult to go into a trade knowing that you have a 34% chance of being successful by November. But the neat thing about the software is it also will show you what the probability of it getting up to there some point during that time cycle, which is what we call duration. So what we're going to do here is we're going to change this ROC, which is return on capital, to probability of a touch. So what Mary does is she clicks on one of these columns. Here's slope. She clicks on any one of these drop-down menus, goes to option theoretical Greeks and probability of touching. Now, all this stuff is built into your technology. And here's the neat thing. Now, when you look at the probability of touching 65, the chances are 72%. All of a sudden now, as an individual investor, if your target is 265 because that's your price objective, now you're thinking in your head, okay, based on all this activity that's going on and based on the total amount of liquidity which is in this stock, which is very strong. I know it's only about 10% of Apple, but it's still one of the most liquid stocks out there. You end up thinking, okay, you end up knowing there's a 72% chance that my price objective's going to be met the day that I put this trade on. Now, what that does is, for every individual investor, again, I keep using the word context, but it's so damn important, I'll change the definition. It puts definition around things. We like definition. My grandmother would sit in front of, she died, but she would sit in front of the Weather Channel for the last 10 years of her life, because she wanted definition about the weather. But she never went outside, but she wanted to know what the weather's going to be. We sit in an airplane, and we're coming from Chicago to San Francisco, and we say to ourselves, we go, you know what? The pilot comes on and goes, we're going to land in 4 hours. Now, we know we're going to land in 4 hours, but we want to hear that guy say we're going to land in 4 hours. We don't want to hear him say, we may land in 4 hours. We want to hear him say, in 4 hours we're going to land, which I like. I like the fact when the pilots come on the PA system and they go, thank you for flying with us, and there's still 35 minutes left to go on the flight. See, that shows confidence. I like that. They've actually set my expectations and they have defined the fact that we're going to land. I like that. In this case, November 265 calls, there's a 72% chance to get there. November 240 puts, there is almost a 70% chance we get there. Now, again, what this does for you is it gives you the confidence in your strategy that you select to know that at some point you're going to be right. What this does is it changes the mentality when you're putting on trades. So here you are, you're sitting in front of your computer screen, and you're saying, you know what? If I give myself 48 days, at some point in the next 48 days, there's a 70% chance we're going to trade 265, and there's a 70% chance we're going to trade 240. Now again, what this does is it sets you up to allow you to put strategies on to give you time to be right. But you know all along, because in the back of your head, 70% chance we get there, but only a 35% chance that we close there. So if I'm betting on the zero-sum game philosophy, at some point I have to learn to take profits. At some point, when we get to our target price, we have to learn what profit taking is about. Because you're going to touch both numbers. 70% chance you touch both numbers. If you're just waiting for a close, you can't make money both ways. If you're just expecting to touch both sides, you can theoretically make money both ways. What the self-directed investor has never been able to understand from a domain side, which is not complex. It's just that we've never supported the strategy to do this. If you sell that strangle, if you bought that call spread, it doesn't matter what the strategy is. If you understand that there's a 70% chance we're going to get to your number, but only a 35% chance that we're going to close there, then the mentality says when we get to our price objective, we take profits. And then when we get to our price objective, the other side, we take profits again. And that's why this professional trader, when I walked over there, I was a professional trader. When I walked over there, I said, this trader makes money 90% of the time, 80, whatever it is, and that's the reason. Because they understand that when you reach your price objective, the chances of you necessarily closing there, not that good. The chances of you trading there, very good. So when you get there, you take profits, which is called managing winners. And that's why the zero-sum game works. And that's something that's been very difficult to articulate over years and years and years from our perspective. And we're just learning how to discuss this now with individual investors. It took me 10 years, maybe 12 years, to be able to get this discussion down to where we can say, hey, you know what? Here's how we can define this. This is why a zero-sum game works. Because when you get to a certain spot, you have to learn how to take profits to that spot. Because the expectations were that you were going to get there, but the expectations doesn't necessarily mean you're going to stay there. And I think people start to recognize that, and you can put it into all aspects of business. You know, I'm kind of a freak. I study, in addition to trading and this business, I study businesses. I'm very fascinated with just kind of the whole business world. I like to tell stories about my own kids. My daughter, who when she got out of school, she went to work for a startup in Chicago. And I convinced her to come work for me because I think we have some amazing women that run our business. And I was like, you know, I want you to work for them because you're going to learn, you're going to learn a lot. And she's like, yeah, but you're not going to have anything for me to do. And you're just doing this because I'm your daughter. I'm like, I promise you, I love you, but I'm not doing this because you're my daughter. So she came on board, and now she works. So she was complaining at first she wouldn't have enough work to do. Now she's complaining that she works 20 hours a day and she has no life. And I told you that that's the way I do business. I expect you, she goes, Dad, you expect everybody to work 20 hours a day, and not everybody wants to work 20 hours a day. And I go, well then, there's lots of other jobs. You know, I've always said that. I've liked that. There's tons of other jobs out there. Then go find another job. Because I think there are certain people who like to work 15, 18, 20 hours a day. She goes, but you don't pay people to work 20 hours a day. and now, you know, so she's the heir to the mortgage, so whatever. So she feels a little bit better. But she's trying to make the point. I said to her, you know what? It's not the way you think. I've started a lot of businesses in the past, and the last business we started, every single person that started in the first 6 or 7 years that we started, in the end, I underpaid everybody, and I worked them 20 hours a day. But in the end, there was 45 millionaires. You know, whatever the numbers, I don't know the exact numbers. And I said, you know what? At some point, you'll get paid. Everybody gets paid. You get paid for your hard work. It's the same thing here. You get paid. You ultimately get paid for all the hard work, for coming out here on a Saturday afternoon, for listening to this discussion, which right now may seem crazy, or right now may say, hey Tom, I already do this. I got this down. You just need to hear it again. It's repetitive. This discussion, having this discussion over and over again, and driving the special, you will get paid. Because it's a logic chain. It's not just something, I'm not just up here just giving you BS. There's a logic chain. You can connect the dots. If you walk away from a discussion and you can connect the dots, it's something very different than somebody telling you, hey, you know what? I got this method, man. I'm an engineer. I'm a little genius. I figured out the software. I got the market beat. Because nobody ever has. And what's so interesting to me about this business is there are still hundreds of thousands, if not millions of people that think they got this business beat. The only way to beat the business is you essentially give yourself a little bit of a directional assumption, and then you just make your bet. It's pretty easy to see. TD Ameritrade is really simple. If you go to a 5% chance of getting to that number, that's where they think the risk is too, because that's the regulatory risk. If you go to a 10% chance, that's exactly where a 10% chance, that gives you a 90% chance of success. Now, I'm going to give you one more example. A company out here, we're going to look at Facebook for just a quick second. I started buying Facebook at $38. I was very vocal about it, and I was very public about it. I bought my first 1,000 shares of Facebook, whatever it was, at $38. I bought it all the way down to 18 and change. And stock's trading for, what, 22 right now?
22.
22. And I'm on money. That's a good question. And the answer is because I sell a lot of crap. But I bought my first shares at $38. Now, unfortunately, I also convinced my mom to buy some shares at $33. She quite doesn't have the premium selling thing down yet, so that didn't work. So, but let's make sure I have.
You have 15 minutes.
Okay. So, let's look at Facebook for a second, because I want to show you some very different alternatives when you get to cheaper stocks. I started with Apple, which is a $665 stock. I went up to Google, which is a $700 stock. I went then to Amazon, which is a $250 stock. Here's a $21 stock. Little stock. On my show, I call this Little Johnny stock. Okay? Anybody can do this. So we talked about things for $7,500. We talked about things for $6,000, $2,500. If I looked at a strangle in Facebook, it's $200 in capital. That's how much it costs, about $200, $220, something like that, to do a strangle here. If I took the same kind of logic, but instead, because it's a cheap stock, instead of going to a 2 standard deviation move, I'm going to go to a 1 standard deviation move. Normally, most businesses look at risk, and I'm sure a lot of you in here that are engineers, a lot of you in here that are statisticians, or you have a lot of probability background, you understand that a 1 standard deviation move, if we're looking at both sides of that, we're going to fall inside of that about 68% of the time. Okay? So in order to find that, we've got to go to the 16% chance above the market and a 16% chance below the market. Add them together, 16 and 16 is 32, subtract from 100, 68% chance, and that's how they figure out standard deviation. In other words, picture this bell curve. Picture there's a 16% chance of getting to the top of it and a 16% chance of getting to the bottom of it. That means the chance of falling outside of it are 32%, falling inside of it is 68%. That's a 1 standard deviation move. That's how most people kind of look at risk. So what we're going to do here is we're going to go to the 16% chance. Mary took the cursor perfectly. To the November, we're going to look at the November 16 puts, which are trading for 30 or 35 cents, and there's a 16% chance to get there. And then we're going to look at the calls, which have a 16% chance, which are the, let's look at the 27 calls. There's only a 14% chance, okay? So there's a 14% chance we get to the call side. There's a 16% chance we get to the put side. Mary's going to take her cursor, she's going to right-click, she's going to move her cursor to sell, she's going to move her cursor to strangle, she's going to left-click on strangle. When she gets there, okay, it's going to show probably about 75 cents or so.
I hit the wrong one. I know I hit the wrong one.
Okay.
Sorry. We're good.
There you go. So the amount of capital required to make this trade, I was told $225. And the max profit, $75. And now let's start to think about return on this. Because on the early returns, we were making 5 or 6 or 7%, right? Or 8% when we went to a certain assumption. What's a $75 return on a $200 investment? It's close to 30%, right? So now all of a sudden you're thinking, okay, for $215, I can collect a 30% return in Facebook. I get Facebook, I got $200. I'm starting to think risk-wise, okay? I could put up $200 to collect a 30% return for 48 days, multiply it by 7, and we're talking about a 200% annualized return for trading Facebook right now. And the reason for it is the implied volatility in there, because they have earnings coming out in November, or before November expiration, is about, close it up for a second here, is about 66%. So it's a much higher implied volatility, which gives a much greater return. And what did we do? In Google, we have this really narrow standard deviation thing. So in Google, the standard deviation thing is like, the curve is like this, okay? This idea, it's like this, like this, like this, okay? When we went to Facebook, it's put 2 of these together and put them sideways. It's this wide. So the bottom of the curve in Facebook is this wide, and in Google and Apple, it's this small. So this return is about 6% and on 48 days, or 7%, and this return here is 30%. All because we just tweaked our risk a little bit, and you know what? It really doesn't make a difference what stock this is. That's how simple the logic is. Now you're working your way through the logic chain, and you understand that, okay, this is the way the whole industry is priced, so he's not making this up, and this is a really liquid underlying because it traded 65 million shares on Friday. And Friday wasn't that busy, traded 65 million shares, and then on top of that now, I'm collecting a 30% return, putting up $200. That's a great way to experiment and learn. Now, let's think about risk for a second. Where's our risk on this trade? Well, if we're collecting 75 cents, we're subtracting 75 cents from the 16 strike, which means our break-even is 15.25. So the statistical chance of getting to 15.25 is probably around 13 or 14%. That's break-even. You take the credit received, you add it to your short strikes, and that's your break-even. And the upside, it's about 20, we're talking just, 10% chance, something like that. So you know what? It's really interesting because most people will think, let's just put this into perspective. If you walked into your bank today, your bank, okay, you walk into JP Morgan or whatever it is, you walk into JP Morgan and Jamie Dimon himself greets you. He says, hey, how you doing? This is a new policy we have. We're going to turn everything around. I'm greeting every single person that walks into a JP Morgan or Chase branch. So Jamie Dimon greets you and he...
Do you want mine? Yeah.
Hold on 1 second. I lost that.
Oh, I have those.
Hold on, just went there. He does this all the time. I use the wrong letters. Okay, so we walk in, and again, Jamie Dimon greets us. And Jamie Dimon says to me, hey Tom, you know what? You've been a good customer. And I really don't think he's going to say that because my last rant on him didn't go over that big. But let's say he doesn't recognize me. And he says, hey, you know what we're going to do? I'm going to give you a chance to make 200% of your money this year. But your break-even number is you have a 72.5% chance of making 200% on a very small amount of money. So in other words, I'm going to let you put up, let's say I have $100,000 at JP Morgan. I'm going to let you put up $2,000. That's it. $2,000, which you have a 72% chance of making a 200% return. Do you want to do it? I've only got 10 left. That's how it gets me. I'm like, I blindly say yes. Just like every other person in this room, just like 100 million people in this country. Okay? We blindly say yes. Hey, and the reason I said only $1,000, $2,000 is because I'm limiting the amount of capital. I'm staying small. I'm staying small and diversified. So I'm saying, you know what? I'll do that. With 1% of my capital or 2% of my capital, I'm happy to do that. Because I understand what the risk is. And every one of us says done. But yet we'll sit here in a real marketplace and we'll look at this screen and we'll say, you know what? I've been told for 25 years that if you do this, you're going to lose your house. If you do this, they're going to take my kids away. If you do this, it's like you can't remember, you guys know until Bill Walsh got here, you couldn't win a Super Bowl by throwing the ball. And it's the same thing for investing. I mean, I'm not trying to make a dumb football analogy, but it's the same damn thing. Ultimately, we're learning now that in 0% interest rates, with 0% interest rates, okay, nobody makes any money. And the people that lose money, most of the money is lost seeking returns because they don't have a statistical advantage. Anytime you have an efficient marketplace with a statistical edge and you do a small enough amount of commitment with a long enough duration and enough diversification, ultimately the numbers have to come out to exactly what these are. I always have this conversation. I use as part of my discussion. I talk about long-term capital management. I kind of talk about Myron Scholes. I talk about risk-free, Black-Scholes models, and genius failing. The reason that genius failed years ago and failed multiple times is because everybody gets too big. And it's one of the most difficult things. I deal with the same issue personally when I trade for myself. And when you get really successful, what happens is everybody gets too big. We get too big in everything we do. You make one good real estate deal, you put all your money into real estate. You buy one good thing, artwork, you have one good marriage, it doesn't matter. You do something. You end up over time, okay? You end up over time. You do something right, and you think that's the way you've got to do everything, and put everything into it. Investing, what we learned, probably the best thing that I've learned over the years from being an individual trader and from being kind of my own little money manager is that if I stay small enough, I'm almost always successful. It's only when this thing starts working against me, when I start to think, hey, you know what? That move is parabolic in Google, so I've got to get short Google up here. What works for me is if I say that move is parabolic in Google, so I'm going to tweak the call side versus the put side so I can play a little bit more downside. Like in Facebook here, I'm bullish in Facebook. But I have no problem selling upside calls. I'm just going to raise the level of the puts I'm selling so that I have more risk to the downside than the upside. Again, the approach that we take and the approach that we want to deliver home from this discussion is anytime you can add a logic chain supported by context, definition, and then you can just connect everything together, then you're no different than every other successful investor has ever been. I mean, the days of putting money into an account and waking up one day having it be worth $1 billion, probably not going to happen again. If you remember back to 99 and 2000, that's not going to happen again. If you remember like an 87 crash and you got lucky to be long some puts, that probably doesn't happen again. Most wealth is maintained and is created through the continued use of this kind of trade objective. Can you find a hole in it? What's the hole? Go ahead.
How are you defining risk here? Because it's a ball.
You're not. This is not.
That's the call that you're selling against. You'll have to deliver, correct?
I made a mistake and you caught me. I did a Simon Says thing and I was wrong. I didn't mean to say the word defined risk. This is all undefined risk. This is theoretical, undefined risk. There are ways to define risk. I didn't do any of it today. I left that for JJ. That's the boring stuff. I didn't define a single bit of risk today. What I did was I defined just the numbers around the trade. That's all it is. I essentially said to you, if you do something like this, you need to understand that if you are willing to limit your profitability, you can define your statistical chance of success. That's what I meant to say. I apologize. So, but can we find a hole? Go ahead. What's the name? Okay. There are, okay, so I don't, just so we're fair, I don't work for the brokerage firm anymore. So when those are all, you have to work with the broker. I can't talk about commissions because I don't work for them. Transaction fees are a big part of this equation, but as you get more active, okay, you can work with your firm and you can discuss transaction fees and things like that. Everybody is, you know, there's a happy place for everybody transaction-wise. And let me explain that for a second. Something people don't understand. The counterparty pays too. So everybody pays about the same. That's why the Chicago board, that's why the Mercantile Exchange is worth it's worth $35 billion. That's why the CBOE is worth X number of $1 billion also. The exchanges make money because everybody trades. But the interesting thing is, there's a facilitation that takes place. I will argue that if you understand risk, which is what we're talking about here today, and you get that they actually clear the back end of every single trade, for me, this is fascinating because what we've seen happen over the last couple of years is when there isn't a balance sheet to back you up. Now, again, I'm going a little bit off target here, but if you remember what happened with PFG, if you remember what happened with MF Global, there was essentially no central clearing engine that was able to guarantee the trades. And what ended up happening there was a lot of customer money loss. The nice thing about this business is it's supported by huge balance sheets, and there's never been a penny loss. So I will argue that the mechanism for whatever the exchanges or the brokerage firms make is a small price to pay if you use their products correctly, which is if you put the end risk on them over a certain chance of the event happening, it's an inexpensive way to participate. Can you imagine MasterCard or Visa essentially saying to you that all the risk is on us over a certain amount? It would never happen. So I think the rates that they charge, again, everything is negotiable and all this stuff, I think the rates that the individual investors pay, I pay the same as you. I think the rates that everybody pays are pretty fair because even the traders on the floor pay almost the same amount of money. In fact, we've had arguments with traders on different floors who are like, we pay more than you pay now. Individual investors are in the best position they've ever been, that's you guys, with respect to the content that you're getting now from places like us and from the technology that you're able to trade on and from the fees that you have. Remember, you pay nothing for the fees. And the brokerage firm, listen, they have a nice business, but their only source of revenue is transaction fees. So I'm not defending either side, but it's pretty fair when it all boils down. What other business can you get into where you can create a 90% chance of success in an efficient marketplace with no fees. Let's think about this. I mean, let's be realistic. If the average price the individual investor pays for an option contract is $2, is $1.50, let's say, and you're talking about a strangle that you put up $220 for, where else can you collect? Where else can you put up $2 or $3 in fees total to collect a 30% return for 48 days, where somebody else guarantees all your risk? That's a pretty efficient marketplace. It's actually a pretty amazing marketplace. So, all right, I'll take one more, because I usually don't. Go ahead.
Could you give an example of the credit, the probability of touching, just something about use that example?
Sure, let's do it. So let's just say, you bought a collector's item, okay? Let's say are you a car collector? Let's say you bought a special car, and all of a sudden those cars got, at some point over a 10-year cycle, whatever car you bought, like a 1969 Corvette or something, gets hot for that short period of time. And at some point over a 10-year cycle, going back for 50 years, once in every 10 years, that Corvette happens to be a really sought after item. If you sell that Corvette at any point during an uptick in that particular pricing cycle for that, that's an example of that probability of a touch. Because what it means is, over a 10-year period, that Corvette's going to move by the rate of asset gains, just general commodity price increases. So if commodity prices, for example, or asset prices increase by 10% a year for a 10-year period, after 3 years you've got 30%. But if in that cycle, after the first 5 years, it goes up 200%, you have to be smart enough to know that that is your event happening, and that's your probability of a touch. I mean, it's a classic buy low, sell high.